So we have both Clint and Joel. This call is so important that I got Clint and Joel here. So I want all of you to ask your smartest, best, most stumping questions that you can come up with. And I want you to direct them to Clint and I want you to direct them to Joel because they are both joining us live and in person today. No, seriously, ladies and gentlemen, glad that y'all are joining us on this kind of a sleepy May day. It was kind of a sleepy, slow May morning, and the markets have been kind of reflecting that with all the information that came out over the weekend. We still are just kind of having a sleepy week, a little bit up yesterday, a little bit down today. Earnings season is over, and we've had a slew of tariffs in the last 6 weeks that have, as I just said to Clint, run up, run back, run up a little bit. And Moody's downgraded the U.S. Treasury debt from AAA to AA over the weekend. And of course, there was a flurry of tweets and no telling how many other social media posts about that over the weekend. I'm sure that all of you were following those, but we're going to get Clint to help us sort it all out. So with that, Clint, I'm going to kick it off with you. Tell us what's going on, please.
Yeah. So thank you. And thanks everybody for joining today. Yeah, markets have not been boring to start the start the year. It's hard to believe it's already May, but we started off the year and our Treasury Secretary, who I greatly admire because he is a macro hedge fund manager first and foremost, but he came out and said, hey, we're going to reprivatize the economy. We're going to focus on lifting the bottom 50%, essentially by easing financial conditions, and we're gonna focus on Main Street, not Wall Street. And all these initiatives, although grand in gesture and thought, are needed at this point. But I think the way to define this as a regime change, and I think this regime change is great. I think it's symptomatic of what's happening from a broader economic perspective when you think of where we are as a globe. And I think it's beneficial to the US. So I'm going to first and just reiterate on our annual outlook, we talked about three mega trends that we felt are going to drive returns over the long term. And those were number one, deglobalization. So this move from a global economy to more regionalized economy. The US really leading the way in that because we've been policing shipping routes and allowing globalization to happen under our security watch. Now we're really focusing on regionalizing trade. So what we're seeing to start the year is really this effort to regionalize trade, this effort to renegotiate trade arrangements that were instituted under the global order. Now we're shifting those to be more beneficial to a deglobalizing world. And I think the US really emerges out of this a clear winner. So that's the first mega trend. Second is what's going on in AI. So AI is a productivity miracle in terms of my belief. So it's just computers becoming more efficient at computing, at taking data and delivering valuable insights and also valuable products from that data. We've never been close to what I consider is a beautiful expression of human existence, and that's creativity. And I think we've never been closer to creativity to product as we are today. And so I'm very excited about that. And that is coming with a tremendous amount of investment opportunity because it requires a lot of capital. And that's where we get to our third mega trend, and that's fiscal dominance, which just essentially is another word or another phrase rather for money printing. And so that's where we sit. Those are the three mega trends we think are going to drive returns. And the good news is we think the U.S. is going to be the emergent leader and dominant regime out of this. Now, that's the good news. What's the troublesome news? Well, as our Secretary of the Treasury, Scott Bessent, said, to reprivatize the economy, to move from the old world to the new world, is going to involve a detox period. And that detox period is another word for regime change. And so change can be stressful. Change can be problematic. But I do think that those problems are short-term rather than long-term. And when I speak about problems, I'm not necessarily talking about the markets per se. Markets are going to do what markets are going to do. I'm talking about economically. And as a reminder, our view is we want to align our investment thesis, our investment portfolios, along with what's going on economically. So just as a reminder, this is our investment framework. We start first and foremost with where are the areas of opportunity long-term from a value perspective? That's the Warren Buffett piece of our approach. Number two, we talk about where's the business cycle? Are we accelerating? Are we decelerating? And then how does policy going to respond to that? And then lastly, we look at market trends. So what are prices telling us? Because prices lead sentiment. So all of these are very important for us to understand where we are from a tactical perspective. And when we build portfolios, we really think through these three lenses. And I know it's four things, but business cycle and monetary policy we look at together. And so we've never been, well, at least in my career, which I started in 2006 in this industry, I have not seen in that near 20-year period, I've not seen an opportunity like we see today in terms of expected returns in asset classes. We have emerging market stocks priced for 10% plus returns. We have global real estate priced for 10% plus returns. We have US real estate priced for almost 8% returns. We have US small caps priced for 8% returns. We have mid caps priced for 7% returns. But at the same time, the US mega cap 7, the mag 7 names, the S&P 500 is priced for about a 0% return. And that's an expected return over about a 10-year period. So we've got this amazing opportunity, but where we see the opportunities are not in the areas where they've been. It's not what's worked over the last 15 years. It's what is set up to work, hopefully, over the next 15. Number two, we have this environment that's this detox period that's going on. The economic cycles continues to be in a decline. If you look at leading indicators, we got leading indicators out yesterday, which I'll talk about here in a moment, but they continue downward. And so now we're starting to see growth slow. And in fact, 54% of the jobs created over the last year, according to the QCEW report, actually didn't exist. So 54% of the jobs that were stated to be created in the US over the last year here economically and aggregate payrolls actually did not occur. And so we're starting to realize that the economy has actually been quite weak. And it's been overly reliant on government support, and that is changing. The good news is that's going to lead to private sector growth, in our opinion. Bad news is that detox period can be somewhat scary. So a growth scare is what we see manifesting over the course of the next few months. And then from a market trend perspective, we've moved to negative trend. We moved to neutral late last year. We moved to negative early this year. And now it looks like we stay negative, even though we've had a nice rebound in markets. Intermarket relationships have still remained pretty negative. So we're probably going to be that neutral to negative camp unless markets break out to the new highs. I'll talk about the good things that are happening from that perspective or the positive things that are happening. I'll talk about some of the negatives as well. So let's get in. First of all, in April, we published a report that said, hey, we're going to get most likely a bear market bounce. So we had a bear hopping on a trampoline, which I created with AI as a way of saying, yeah, I think we're going to get a significant bounce. The good news is we got that bounce. The other good news is that this may actually be a continuation of a bull market if we can break out and sustain above old highs. So that's what we're waiting on now. We have a date with old highs that looks logical. We had kind of this 5,700 to 5,900 band, or sorry, 5,600 to 5,800 band of resistance that we are targeting. We've eclipsed that, so which raises the probability that we at least visit old highs and could potentially break those old highs as we get into the summer. So that would be a great sign. We hope that that occurs, although we're still attaching only about a 33% probability that that happens. And I'll get to the reasons why here in a second. But before I do, I want to remind everyone what bouncing bears typically impact. So if we can't break out to old highs, this is pretty standard. This comes from Dr. Hussman. And he simply said, remember, the first line down following a market peak is typically vertical. It's steep. The steep initial losses typically make investors feel like fools who sell into the decline, and the clearing rallies that follow convince them that everything is still fine. That process in repeated sequence is why investors tend to hold on the whole way down, often eventually capitulating at the lows. So this is not abnormal. We've seen a very sharp sell-off followed by a very sharp rebound. And now a lot of folks are left confused. All right, so let's get into the valuation segment. Well, the first thing I want to do is honor the gentleman who we, modeled our valuation component or expected returns component of our framework after, and that was Warren Buffett. And Warren Buffett did a 5.5 million% run, and he has since retired in glory. And I want to wish him all the luck in his retirement. And I want to say that our industry has forever been changed in a positive direction because of this man. And so I want to start first and get to the S&P 500 based on his indicator. And this is the Buffett indicator. And this is one of the most amazing opportunities we see today. The market cap weighted indices, so meaning the companies, the S&P 500, everybody thinks is a passive index. It actually isn't. So what happens is the companies that are the largest in market capitalization get the most money. And we think this is the primary reason why markets are why the S&P 500 is priced for such low returns, and why we think we have such an awesome opportunity if you look elsewhere. Because if you look elsewhere, if you look into either equate the S&P or you look to sectors that are doing well this year, like dividend growth, for instance, or low volatility equities, there is a tremendous opportunity to rotate out of these market cap names and into these area or out of these market cap indices and into other weighting schemes. And we think that this presents a unique opportunity for investors. In fact, it's one of the highest valuation readings we've ever recorded, second to only 2021. Yes, even north of what we saw in the tech bubble, but also the highest concentration we've seen since the Great Depression. And so this is an opportunity we want to capitalize on. And we want to capitalize on with portfolios by, number one, equating portfolios, and number two, rotating to some other segments or having the capability to rotate to other segments that are undervalued. So that's the first thing we want to look at. Now, when we look at the business cycle, we see that leading indicators continue negative. So what does that tell us? It tells us that coincident indicators are going to follow suit. We got that big job revisions number last week. We saw 54% of jobs evaporated from the last year, 400,000 jobs that were stated to have been created over the last year. It actually was a loss of about 160,000 jobs. So the government does a really good job at making numbers up, and we're finding out that they're usually made up to the high side. So we'll see if that continues into other trends. We also look at economic policy uncertainty is at an all-time high. And this goes back to what Chris was talking about with tariffs and the back and forth. There's such an amazing amount of change happening. It seems like on a daily basis around trade. Now, we think this is all for good reason, to reprivatize the economy, to renegotiate these pre-deglobalization or post or globalization related trade arrangements to really support a regionalization of our economy. And we think that this benefits the U.S. because in a deglobalizing world, it's the countries that are energy independent, agriculturally independent, and can print money that benefit, and we can do all three. And so this economic policy uncertainty, we think, has probably peaked, and we think we're going to get more clarity. Even though we're going to have most likely some short-term pain, we'll get some more clarity as we progress. And why do I think we'll get more pain? Well, typically hard data follows soft data. We've seen confidence and uncertainty increase, and now we're starting to get the hard data that comes down. So last week, we got real retail sales, which has essentially been flat for a year. We got industrial production that shrank month over month. We're now starting to see PPI or inflation shrink. And so all these things are going to continue to materialize. And now jobs numbers are getting worse. We're going to see unemployment most likely go upward. And so this hard data will follow soft data most likely by our estimation. And that's where we're going to start to hear more and more talk of recession. I saw Jamie Dimon still thinks there's a 50% chance of recession. Again, just to remind everyone, I don't think that even matters at this point. I think what's really important is just allocating to the factors that do really well during economic slowdowns, and also looking forward to when this economic acceleration happens, being in the position to capture that. And so we do see that continuing to happen. We're seeing unemployment trends pick up. So job cuts are picking up, job openings are shrinking, and these are all usually leading indicators of unemployment. When you also look at what we're seeing from a economic perspective, we're watching inflation very closely because inflation is going to drive Fed policy. Now, this number has since creeped up to about 1.99%, but the good news is inflation has essentially evaporated in the US. So we're below the Fed's target by our estimations, or right at the Fed target, and we think that opens up to the Fed cutting interest rates. And we know the Fed needs to cut interest rates because the Fed funds rate, this orange line, is above the 2-year rate. And the 2-year rate is what needs to drive Fed funds policy. So to be easy, to be supportive of growth, that yellow or that orange line needs to be below the purple line. When it's above, it's restrictive. And so policy is overly restrictive right now. And that's why we're not getting the credit growth we need to support an economic acceleration. All we've had is really government support to support an economic stagnation, and prevent a slowdown. Now we're getting that slowdown under the new regime, and we really need the Fed to step up to spur economic growth. If they do not, then what we're going to have to rely on is more fiscal spending in that department. From a market trends perspective, here is what we kind of outlined in the bear market rally where we top out. We thought we'd top out around this 50. Let's see if my cursor works here. We thought we'd top out around this 5,800 and then bounce around here, right? Before making a decision to potentially break lower on the economic scare, which was our base case, at least to retest this area, or if we got an economic acceleration, to eventually move up. We've actually moved up, and it looks like we're going to have a date with old highs, and then we're going to see what happens. Do we consolidate from there and have wider swings before breaking out or breaking down? We don't know. We'll have to wait and see. But the market has exceeded and reclaimed really key levels of technical resistance, which are now support. And so what happens in the ensuing pullbacks is going to be really, really important for future direction of markets. At one point, we were worried if the market failed too early that we would take out the old lows and actually move closer to fair value on the S&P, which is around 3,800 or 3,500 rather. That doesn't look likely at this stage. So watching what happens in markets, especially the S&P 500, as people continue to move money out of tech and into these other segments of opportunity, it's going to be really, really important to watch. Now, why do I think markets are going to revisit old highs? Well, one of the reasons is we're seeing international stocks break out. And then last week, high yield broke out too. So international stocks V'd up, and then they broke out 2 new highs right here. And that is a good sign. So retesting the old highs for the S&P would not be an abnormal experience here. And again, international markets had a really sharp reaction and then rebounded as sharply. So if leading economic or leading indices like international markets continue to lead, then this is an expectation that, hey, maybe markets really do have clear support to reclaim old highs. We just have to wait and see. This was a very sharp reaction, and we have to make sure that we get more information and true trend change to support the S&P upward. Some of the things that aren't working in the favor is we still have a positive trend favoring low volatility equities. So low volatility equities remain in a positive trend. Copper relative to gold is not getting a bid that supports global growth acceleration. And remember, the last few times we've gotten V-up rallies, it's happened because of stimulus. And so stimulus didn't come in on this one. We didn't get enough significant stimulus. The stimulus was actually in a Russian imports, not Russian imports, but a rush in imports to front run tariffs. And that was largely out of Europe. And so it made sense why Europe rallied and really carried international indices to new highs. That made sense. Also, you had the dollar weakening in that phase, but seeing the S&P resume its uptrend and break out to new highs would be quite abnormal, considering that the economic news is still the same. Tariffs are still on the table. You continue to get degradation in earnings trends in terms of earnings revisions negative. You continue to get move lower in coincident indicators. All of these things suggest to us that, hey, we might have more, at least a difficult time reclaiming those old highs. Market environment still positive though. In fact, this has moved up to where it's about 77% now, the S&P 500 on buy signals. So we still have room to the upside. I'm not going to ring the bell and say we've topped here from an intermediate basis. That usually happens when this index rolls over and moves into a column of O's, and we're just not there yet. So, Chris, those are my prepared comments. I know I went 5 minutes over, and I apologize, but I tried to hurry through.
Clint, you're never short-winded. So
That's right.
no
Very
one
true.
ever accuses either one of us of being short-winded. So ladies and gentlemen, listen, this is what I want you to do. If you have questions about markets or economy, or if you just really want to set off a cherry bomb in the middle of the table and you want to ask questions about politics, feel free to unmute your phone and ask those questions. So Clint, as people are going to do that, this is a question that how much of the world, this is just one of those opinion driven, just of all the talking heads I've listened to, seems that President Trump's administration has just ripped the Band-Aid off of deglobalization. The last 5 years since COVID and all the stacking up of the supply chain, 60% of the world gets unemployed, supply chains all over the world just back up. And American companies realized, hey, we've got supply chain issues with the globalized economy. The administration realizes, hey, we've got issues going on with the globalized, even national security risks. And so President Trump's administration has ripped the Band-Aid off. But I hear the talking heads going, oh, no, no, no. The rest of the world is fully on board with a globalized economy. It's not just the United States that is taking its ball and going home, essentially. Do you think that's a true statement, or is the rest of the world, primarily the powers in the rest of the world, are they kind of scrambling around and creating regional economies themselves?
Yeah, no, this is not just a US led thing. In fact, the US has been uh, frankly the one that has received the brunt end of the stick as it relates to trade policy globally. And that works when you're the world's reserve currency. So because you can operate with a deficit when other nations cannot, because you borrow in your own currency. But the problem with that, when you're the world's reserve currency and you're running at a deficit and other nations are running at a surplus, is it's very painful to rebalance. And that's all we're essentially trying to do is we're saying, okay, we've allowed other nations to really benefit from number one, dollar pegs and currency manipulation, which I think is the biggest issue. So countries peg to the US dollar and then they keep their currency weak relative to the US dollar to have a trade advantage. That's what I mean by unfair currency manipulation. And so this is benefited because what it does is it attracts capital, right? Because you become the human capital resource for US consumers. Consumption, 70% of our economy or higher. And so that really does put us in an unfair advantage in terms of exportation. Well, now that we're in a deglobalizing world, exportation really, really matters. And you got to think about what are we going to export? Well, number one, not only supply chain matters in terms of the things we need to export, but also national security things. But we want to export critical industries that are the the envy of the world. So AI is very, very important here. So chip manufacturing and protecting chip manufacturing, protecting that intellectual property, and then shipping that is very, very important. Number two is energy related. The countries that are energy independent are the ones who emerge victorious in a deglobalizing world as long as they have a strong military and can print money, right? And so we have 100-year supply plus of natural gas. If you look at a lot of these trade arrangements and the tariff negotiations, they're a lot about shipping liquefied natural gas. The next thing is agricultural products. If you look at the UK trade arrangement, that had a lot to do with buying agricultural products as well as energy products from the US or US allies. That is very, very important as well. And so we're regionalizing the control of those supply chains because we need to be able to export to continue to benefit and maintain dominance for the US. And so that's really what this trade arrangement is. Other nations have been doing this for forever. We're just the ones who have allowed it to occur because a bigger pie benefits everybody, even if our slice of the pie has shrunk. But you got to remember our slice of the pie since the Industrial Revolution has shrunk considerably. And so we're putting a stop to it. Now,
All
under
right, fair
that,
enough on that. But I'm gonna push back. There's a couple of things on that though. And this is just me playing devil's advocate, not taking a political side on that. But the United States has gotten very rich under all of those arrangements,
that's how
and
it's
we
got to go.
buy the rest of the world's cheap stuff.
Yes.
So aren't we going to? I mean, the you know cheap stuff like a cheap pair of flip flops that cost the same now as they did in 1998. Is that gone? Or
No.
are we going? I mean, we go buy a bunch of expensive stuff made in Kansas now because we're going to
No.
move all the manufacturing back to the United States.
No, that's not going to happen. It's the manufacturing of critical industries, right? And then it's about regionalizing the manufacturing of critical supply chains. So, meaning South America is going to probably be one of the clearest benefactors of these trade policies, as well as Mexico. And we're not going to be over here manufacturing shoes and trying to wear US made shoes or, any of that. What we're really intent on doing is we're going to increase automation and robotics for sure, but we're really intent on increasing the shipment of defense goods, energy and energy infrastructure. So that's going to be really important. Healthcare and pharmaceutical goods, which we've outsourced a tremendous amount of those supply chains, and then technology. Those are going to be the key industries we're focused on producing and exporting here. And then obviously, I did mention energy, but agriculture as well. But a lot of it's going to be about regional supply chains. And so we're not going to get rid of the US consuming cheap goods, especially from a consumption related perspective. But part of the negotiation is to threaten those industries, the ones that aren't that important, so we can get the critical industries back here and the critical manufacturing back here and the critical supply chains back here, and then allow the cheap good manufacturing to still occur in the nations that they occur in. That is the efforts of the administration currently.
Okay. So how does how will tariffs really affect inflation?
Yeah, they're deflationary first and foremost. If they
You
are
know, you're
long,
like the only person I hear say that, though,
I know
don't you?
it's true though. Actually,
Okay.
Scott Bessent said it. He said it on CNN or MSNBC last
Oh,
weekend.
okay. Yeah, but he
Uh,
sounds like a politician saying it now, not a portfolio
That's true.
manager.
Even though yeah, exactly. Even though he's from the opposite party that the current administration's from, and he
He
is a hedge
is.
fund
He
manager.
really
Yeah,
is. He is a Democrat hedge fund manager
that's
working
right.
for a Republican politician. That's
Yeah,
interesting. All right,
but
keep
yeah,
going.
they're deflationary, and here's why they're deflationary on the front end. Because what they do is they slow trade, and so deflation is growth and inflation slowing. Inflation is growth and inflation acceleration. Stagflation's growth slowing and inflation accelerating. So I think those definitions are really important for people to hear. Long-term high tariffs um, are stagflationary, but as a form of trade negotiation, they halt global trade. So they are growth and inflation slowing today. So that is why I say they're deflationary. And that is precisely what we've seen in the data. Conference Board just had the steepest monthly decline in leading indicators that we've seen in the month of April. Inflation has essentially crashed. If you look at 6-month rate of change of oil markets, of Brent crude oil, which I tend to look at to track inflation, it's down 9.62% on a 6-month rate of change. That tends to match up with inflation. And so if you look at the Truflation, which I had up here, this is the Truflation report. That is the peak in inflation here was 3% in December, and it has since moved downward. So growth and inflation are falling. That is just the data. And reporting that data, that's deflationary. And so that is how tariffs are temporarily. Now,
Yeah.
long-term tariffs, so again, could be stagflationary, but I don't anticipate that being the case here. I think it's just a trade negotiation ploy.
So the fear of stagflation on Main Street is we have a slowing economy and prices going up. That just
That's right.
sucks all the way around. That's like 1977.
Awful. And it's
Okay.
actually been the regime we've been in, Chris, as you know. We've been bouncing from growth slowing, inflation accelerating to growth accelerating, inflation accelerating for the last 3 years. So that's the problem. That is not a very good environment for Main Street, and that's why you have consumer confidence at the lowest level in history. Not, it's like a silent depression among
Yeah.
U.S. consumers, especially that bottom 50%.
It's why all the economists arguing on Bloomberg that we're not in that we're not in an economy is excuse me, that we're not in a recession is comical.
Yeah.
Because the classic definition of a recession, the two consecutive quarters of negative GDP growth, or which I know you're going to tell me is not the definition, but that's the way everybody else in the world looks at it. And I know it's not the definition. I know the academic definition that you can't quote because it's 4 pages long. But it's why people have felt like we've been in a recession for 3 years. This long, slow, kind of shallow recession. But let's get off that for just a minute. We can start letting some people off this train. But one of the concerns that we had was the Fed was going to have to yo-yo interest rates. And we've talked with a lot of our clients. Hey, look, we have interest rates that are higher. This is a good time to lock in some long-term fixed income, fixed interest rate types of products or investments, annuities, et cetera. So it seems that the bond market is doing that work for them, that the bond market is yo-yoing interest rates. You're nodding your head yes. So do you expect that to continue?
Yeah. So no, I have been a lot of what's happened from a treasury dynamics perspective has been perplexing. So bond markets follow inflation, they follow growth. And so bond market yields, actually, if I plot this chart historically versus 10-year yields, 10-year yields track this chart, which is just trueflation, right? Just inflation chart. What's happened is you've had treasury market dynamics who have, under the previous Treasury Secretary Yellen, that were perplexing. There was a huge issuance of T-bills, and then we ran historic deficits of 6.5 to 7.5% of GDP, and that is very problematic when you consider how the supply and demand of Treasury bonds. There hasn't been any new 30-year issued paper. It's all on the front end. So you had this capital flow to the front end of the curve, and you had no capital, so you had steepening of the yield curve. So short end rates went down, long-term rates stay essentially flat, moved down a little bit, but you had a steepening of the yield curve. That's ending now. The Treasury Secretary has stayed under this administration, even though we issued a lot of T-bills. There's about 9.3 trillion in Treasury issuance, another 2 trillion or so that has to be rolled over this year. It's about 11 trillion in treasuries. A lot of that'll still be T-bills because you got to kick the can down. But ultimately, what's going to happen is this administration's determined to get the middle of the curve, that 10-year rate down, and you're already starting to see a flattening. And so that should have happened before. It didn't because of the way the Treasury was issuing bonds and the way the government was borrowing and spending money. And that is going to change. The government's still going to borrow and spend money, but this administration is keenly aware of the impact and importance of that 10-year Treasury note rate in terms of lowering borrowing rates to the bottom 50%, which is a financial condition they need to ease. They need to do that to spur credit growth. And if the Fed's not going to move rates down, then the fiscal dominance is why I said that's our third major trend. The fiscal side's going to do it for them. And the fiscal side's going to do it through, market-based dynamics. And so that's what you're going to see most likely happen. And in fact, 10-year rates still off the highs. And again, like I said, the flattening, the 2s, 10s is flattening. It's moved down from over 50 basis points to now 47 basis points. And even with a Treasury downgrade, right, which I hope you'll get to next, you continue to see that flatten. And so that flattening, what that does over time is it creates more pressure to the downside on the long-term bond. So yields come down on the long term. It also ignites housing refinancing activity in the housing market. And so it unlocks about 50 trillion in home equity. So maybe it's 40 trillion by then because the price declines, but those rates fall faster than mortgages. And then that ignites.
You're talking about the 10-year. Let me
Yeah.
interrupt you a minute. So kind of bring everybody back to this particular point in the conversation. The administration wants to bring the 10-year rate down because primarily the everyday consumer, what they borrow money in terms of is in terms of the 10-year rate. So when you go buy a house, your 30-year mortgage is based on the 10-year U.S. Treasury interest rate, not the 30-year U.S. Treasury interest rate. A lot of people think that. And so when they're wanting to get that U.S. 10-year rate down. That's why they don't like the steepening of the curve. They're wanting to get that middle part down because that's where the majority of us borrow money from, correct?
That's
Small businesses,
exactly
when they go
right.
borrow money, they're borrowing it based on a 10-year. So that is what's pushing money, and they're trying to push money into the economy via private mechanisms, not public mechanisms.
Exactly. And the best way to do it is to unlock housing market equity. Again, $50 trillion of it. And the way to do that is to shift rates down. And as rates get down, you end up getting a lot more refinance activity, a lot more purchase activity, a lot more money, a lot more equity unwind or released out of the housing market. And as that equity comes out, we do one thing really, really well as U.S. consumers, as people. We spend money and we buy. Everybody in the U.S., we love to spend money, so we'll consume, and that consumption again drives the growth policy. And if real retail sales have been flat for 5 years, right, it's all just been inflation that people keep thinking, oh, retail sales are up, consumers still alive. I don't know what data they're looking at, because when I look at 5 years of data, it is flat to slightly down. It's been a steady downtrend. It's really inflation. Prices have gone up, not volumes. And so that will ignite a resurgence of consumption-based growth here in the US. And we need it, right? We need to unlock that equity. And this administration is keenly aware of that. We have 90-day delinquencies on auto loans at highs. We've got credit card loan delinquencies at highs. We are starting to see 90-day delinquencies on mortgages rise up. We've got a lot of pressure underneath the system because the banks haven't been able to step in and support it through credit growth. And I think this administration understands that, and they need to remove that. They need to open that pressure valve. And the way to do that is by getting 10-year rates down.
Yeah. Okay, so we're gonna wrap up, and I'm gonna give you the last word. Do you want to go to the downgrade? I mean, I got to tell everybody.
Excuse me.
Hey, Roselle, yes, go ahead.
Hey, I know we're wrapping up, but I have these two questions real quick.
Go ahead.
I want Clint, as you said, put on that portfolio head of his and answer this question. Looking 5 years down the road, okay, how do you think trust issues from other countries are going to affect the economic dominance of the United States, or how important is the issue of trust by other countries? That's question one. Number two, do you think Jay Powell's going to make it to the end of his term? And if not, how would that affect the market?
Yeah, those are great questions. Number one, trust is very important. But in a deglobalizing economy, you're going to see a degradation of trust. You're going to continue to see a rise of geopolitical conflict. But this has been happening for some time. So this is just observing a trend that's in motion. So trust is going to continue to degrade. Now, trust in our financial markets will not. And so we've seen and we continue to see record foreign investment in US assets. And as long as we remain an open market from that perspective, that will continue. That's largely just structural because the dollar is the world's reserve currency, or we settle energy, which is truly the world's reserve currency. We settle that in dollars, and our antiquated financial system is still based on that. And so trust will degrade, and that trend will continue, but foreign capital flow will continue to be a force that's difficult to be reckoned with in terms of the US. So money will continue to flow into the US because of those structural dynamics that I mentioned. So as far as
I try to remind people that whether red or blue, money is always green.
That's very true.
And that's one thing that we don't have to. We can erase all the other issues, but it does play a part in just observing what's happening and how you react to it. But I appreciate that, and also, Chris, I appreciate your pushback questions to the portfolio head, because those were some of the same things I was thinking about. So go ahead and finish. I'm sorry. I just wanted to throw that in there. Thank you.
No,
Clint.
I think that was great questions. And in terms of Jay Powell question, which I love, he will make it to his end of term because it would be such a bad market event and bad look if he didn't.
Okay.
Now, here's what I do think will happen though, which is going to be interesting. And this is a pontification, but I imagine that this administration, if Powell doesn't cut rates shortly, because he is too tight right now. And the only reason I know that is because of this chart right here. This is what tells me that. So he needs to be below that purple line. That's when it's supportive of growth, when Fed policy is supportive of growth.
Mm.
So he should be cutting. He's been worried about inflation, and rightfully so, but inflation is
Mhm.
moving down. If he doesn't start to cut and it is perceived as political, and I can see why it would be, because this administration has actually, the president is, calling him names, which is absurd. Then he is, I hope he wouldn't, but he could be incentivized to just say, you know what, I'm just going to stay restrictive. I don't think he would do that. But if he does that, I think what would happen is I think this administration would name a successor long before he's gone, which would render his policy essentially null and void. Because if they name a successor, then the market's going to start looking past the things that Jerome Powell says, and it diminishes his effect on markets. I think that's their chess move if he does, if he continues to be resistant to easing policy. So I think that's your biggest risk, not him being removed, but this administration names the successor long before he finishes his term. And then I think that creates a market destabilizing event. That would not be good for asset markets at all. So that's a higher probability than him removing himself or being removed.
Okay, thank you.
Absolutely.
Are there any other questions? Clint, I want you to speak for just a minute on the downgraded U.S. Treasuries. Does that matter?
Yeah, I mean, look, it matters, but it mattered in 2011 when it first happened. If you look at the market event back then, it was far more volatile than it was today. That's rightfully so. Like, once one rating agency moves the rating lower, everyone moves to that rating agency. This wasn't like an event that should be shocking. I mean, Moody's downgraded Enron after Enron was bankrupt. It's the way rating agencies operate. They're just late to the party. Now, what it does call attention to is that we've got record fiscal deficits. And I love how Roselle said it, right? At the end of the day, money's green. Doesn't matter whether you're red or blue, both sides are going to continue to print money. And that's why I continue to say fiscal dominance will remain. There is not going to be any cutting. Our deficits are going to continue to go higher. Our debt's going to continue to go higher. And just by the Congressional Budget Office's estimate, we'll be at 197% debt to GDP by 2037. I anticipate we'll be much higher than that. It's about where's the money go and does that benefit us as citizens? And I actually think that because of a deglobalizing world, these trends they've happened under the past administration. They're happening under this administration, which is we're continuing to reshore, onshore, and nearshore our supply chains. That is going to continue. Investment in U.S. infrastructure is going to continue, and investment in AI is going to continue because we need to dominate those trades, and we're going to continue to regionalize trade. We're going to continue to invest in AI infrastructure, and I think all of those are going to benefit the U.S. The great thing about our nation is we are in the catbird seat from a deglobalizing perspective. So regardless of the administration that's in office, those themes are going to continue to resonate and be true. But also, we're going to continue to spend money. And so we just need to be prepared for that reality.
Absolutely. Ladies and gentlemen, thank you for your time. Thank you for your attention. Clint, as always, buddy, I appreciate it and enjoy it. And you and I could sit here and ask questions back and forth and nerd out on these topics, but we'll spare everyone that and let them get on with the rest of their day. As always, we appreciate the trust that y'all put into us, and we're working hard for you. So if you have any questions, please give us a call. If we haven't done a review lately, let's make sure that we get together. Thank you for your time.
Thank you.
Take care.